Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, in last week's episode, I spoke about the cracks that were starting to appear in investment markets, and I likened it to Lassie trying to tell us that somebody had fallen down the mine. And the market was trying to tell us something, and it turned out it was. So it's one of those great episodes where you say something and it turns out to be correct. So I'm not Nostradamus or anything like that. It was just the market was showing some indicators that were worth paying attention to. And I wrote a newsletter for 80/20 investor members saying that trouble was brewing, and I went into much more detail with certain indicators and charts. And actually, it proved slightly prophetic for this week. So if we jump to what happened in markets on Monday, we saw the market start to sell off. And if you recall, I talked about the IBEX versus the DAX and saying that the Spanish IBEX was breaking down. The DAX was still managing to stay aloft and afloat at high levels. And I started to say that the financials, XLF, so that you remember that is the particular ticker that I look at, versus technology stocks, which is XLK. It was actually showing continued weakness in financials, but at the same time, technology stocks were starting to show a lack of breadth. We saw real estate investment trusts, so REITs, starting to outperform, which is a sign that there could be a change in the outlook for yields and interest rates. So that's XLRE is the ticker I look for that. And of course, gold was rebounding as well. And we saw growth stocks started to stall alongside value stocks. So it was pointing towards a potential for maybe a transition in the phase of this economic cycle. Maybe growth would start to slow. But as I said, when we went into the beginning parts of this week, the cracks widened and we started to see the market sell off. And it was put down to concerns over the Delta variant of the COVID-19 virus, I should say. So as the virus started to spread, there was concerns that we were going to get a particularly strong third wave, and actually the impact in other countries that haven't been as quick or able to vaccinate its population like the UK has, but the concerns over that. But even in the UK, because there's still concerns that large swathes of the UK working population are now starting to have to stay at home and isolate, and that could impact the economy. So if you go to Monday, the 10-year US Treasury Yield, that was one of the indicators I said to watch in the coming days and weeks. And if you remember, we were at a point where it was testing its 200-day moving average around about 1.25%. It was starting to get backed into a corner, and it eventually broke lower. So we were at a point where it was either going to have to break higher, and we see the rally in yields and the reflation trade perhaps kick back in, or break lower below that 200-day moving average. And we got the latter. And in fact, the 10-year US Treasury yield fell towards 1.13% at its low point on Tuesday. So that caused a big movements, a big shock in markets. And it wasn't just the bond market, but we saw the rapid sell-off of equity markets. And the reflation trade itself was the one that actually fared the worst. So that means things like financials fared badly, but also the wider market did as well. So we still saw technology stocks sell off. So just to give you a recap and of the size of some of these moves, on Monday into Tuesday, we saw the German DAX fall 2.62%. The FTSE 100 and European markets more widely fell about 2.5% on Monday. The Dow Jones Industrial Average in the US fell about 1.9%. These are big moves for one day. The S&P 500 fell 1.5%. And we saw a similar move in Japanese equities too. The Nasdaq actually only fell 0.9%. So we're still seeing that the reflation trade got hit the hardest, but things like growth stocks fared the best. But you might look at those numbers and start to think about the Nikkei 225, that maybe Japanese equities have been doing quite well. Actually, if you go back and look at the last month, then Japanese equities have been hit pretty hard. They're down 4% overall. Now, that is perhaps indicative of a regime shift economically over in Japan, and not just that, but Asia markets as well. If you look at the last month, so I'm talking about from the start of July to now, then most of the other developed world equity markets, they've seen pullbacks and then recoveries, whereas we haven't seen that in Japanese equities. So that's something to keep an eye on. So if you've got exposure to Asian equities, that would have hurt your portfolios in the last couple of weeks. Now, the equity markets as I say, tumbled at the beginning of the week, and it was all being driven by a narrative surrounding the Delta variant and concerns about future global growth. But we did then subsequently see a rebound, and actually most markets, well, the US equity markets especially, rebounded and recovered those strong losses that we saw on Monday. In fact, if you look at the last week, the Nasdaq is in positive territory. So is the S&P 500 as well. Other markets didn't feel quite so well. I mean, the FTSE's still down. Actually, it broke below the 7,000 level, which is a key resistance level in equity markets in the UK. So keep an eye on that and see if we can manage to break above it. But at the moment, the rebound hasn't been as strong. And obviously, we have seen a bit of a rebound. And that's partly because we've seen some respite in the 10-year US Treasury yield and other bond yields. It's actually broken back above. It's rallied back above 1.25%. So it's back above its 200-day moving average. Don't forget, the 200-day moving averages on any indices is actually used often as a sign of a longer term shift or change. If you're above that 200-day moving average, then it's normally positive. If you're below it, it can show signs of potential future weakness. So what we saw in the last week, that the market was trying to tell us something and there was a problem underneath, and we saw that aggressive pullback on Monday, but we've seen some recovery since then. And some of that is because people have started to reassess the situation, perhaps thinking that inflation is still going to be sticky. They've looked at the company's earnings that have been coming through that have been very strong. And also there was such a strong move to the downside, you're always likely to get a bit of a pullback, so a bit of a rally higher. So the question mark is what the market was telling us, is that all over? Is the worst behind us now? And the chances are, I don't know the future, but it seems unlikely because breadth is still poor. A lot of the things and trends that we were talking about last week are still in place. We've not seen yields on the 10-year US Treasury break back above the recent highs that we've had. We want to see it keep pushing higher if the inflation trade is going to kick back into gear. The S&P 500, if you look at that, we're still below that key 4,400 level. As I mentioned, the FTSE 100 is still struggling to get back above 7,000. So there's still lots of things going on in the background that, while the narrative may have changed and people aren't today so bothered about the Delta variant, they're probably going to be worried about it again in the coming days and weeks. At the moment, we've had a bit of a shock. We're listening to the market. Perhaps we should continue to listen to the market because things haven't improved significantly to remove those dangers that I mentioned last week. So is it the calm before a storm, or are we going to see a summer of a lot of volatility and churn like we've seen in the last week? Who knows? One last thing to obviously point out is that central bank policy is in focus as ever. This time it's not the US Federal Reserve or the Bank of England that we're focusing on, it's the European Central Bank today. So they are going to make their latest announcements about monetary policy, and people are assuming they're going to be continuing with their QE initiatives and their easy monetary policy. So the markets have rallied in Europe and the UK off the back of that. If we don't see that easy monetary policy and something changes, then we could have a bit of a shock. So I think what we're likely to get is more of what we've seen in the last week or so, lots of volatility. So there you go. That's it for this week on Damien's Midweek Market. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. You can contact me via Twitter, Money to the Masses with the number 2, and Instagram. We're even now on TikTok, and of course you can find us on Facebook. And don't forget to subscribe to our YouTube channel.